Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
To the top stock picks for the week of December 18th. My name is Andrew Rocco. I'm a stock strategist here with Zacks Investment Research. I'm also the manager of the Tech Innovators portfolio. And let's jump into things. Perfect. So my top stock for this week is going to be Tesla, which is actually ranked a number 4 for Zacks as sell. But I'm going to kind of argue my reasoning for being bullish on the stock over the next 6 to 12 months. And full disclosure, I do own the stock in my personal portfolio. We also own it in the Tech Innovators portfolio, which is the portfolio service that I manage for Zacks. So in case you don't know, Tesla is the undisputed market leader in battery-powered electric car sales in the United States. They enjoy roughly a 70% market share. And over the years, Tesla has shifted from developing niche products for affluent buyers to more affordable EVs for the masses. So the firm's three-pronged business model, it basically includes direct sales, servicing, and charging. And that really sets it apart from other car makers because other legacy automakers are more one-dimensional in nature. So year-to-date, shares are higher by 128%. However, investor concerns are mounting, including valuation and underperformance. So today, I'm going to seek to debunk some of those bear arguments. And of course, the biggest bear argument against Tesla is going to be it's what bears see as a loaded valuation. So Tesla, when you look at its market cap, it's more than the combined value of legacy automakers, including Toyota, Volkswagen, Daimler, General Motors, and Ford, which I know it sounds crazy, but just bear with me for a second. So I think it's more important to judge Tesla from a valuation perspective. You have to dig into it. You can't just look at the overall top line number. But let's jump into the number for a second here. The price to book ratio is a financial metric that compares a company's market value to its book value. So in other words, it's the net value of its assets minus its liabilities, and it's calculated by dividing the market price per share by the book value per share. And of course, a low PB ratio suggests that the stock may be undervalued, while a high PB is just the opposite, of course. So when you look at Tesla and you compare it to another mainstream stock, let's say Apple, Tesla currently has a book value of just 14, while Apple has a book value of 49.54. So all of a sudden, Tesla looks cheap when you compare it to other large cap tech stocks. And also, Tesla's price to sales ratio is at its lowest level since 2020. And those of you who were trading the post-pandemic rally remember that Tesla was probably the top performer. It gained 900% the last time its price to sales ratio was this low. So from a valuation perspective, in my opinion, it's not that expensive. In fact, it looks cheap to my eyes. And I'm going to provide a little bit more evidence as to why that is cheap as well. When you combine the growth of the stock with the price to book. So though its price to book is lower than Apple, many investors may still have trepidation. Is Tesla really worth more than the legacy car makers? To answer this question, we must remember that Wall Street is a discounting device. What do we mean by that? Institutional money managers, aka the ones who move these stocks the most, are willing to pay a premium for growth. So if you look at GM, for example, GM grew sales at a meager 5% last quarter, year over year. Meanwhile, Tesla has achieved a stunning compound annual growth rate, or CAGR, of 72%. 72% revenue growth on average over the past 13 years. So because Tesla's growth is so much higher than its peers, it earns that premium above the slower growing legacy automakers who, by the way, their growth is likely to slow even more as the market moves more towards these EVs. Now, let's jump into some recent news. Last week, Tesla announced that it's recalling more than 2 million cars sold in the US due to issues with its autopilot software system. The NHTSA, which is basically the Highway Safety Patrol, they found that many drivers are not taking adequate action to avoid crashes when the autopilot system is engaged and warning lights are triggered. As such, the EV maker will need to update its system to ensure that drivers are paying adequate attention when their vehicles are engaged in the autopilot function. So one thing I like to remind people of, and if you've watched my videos, you've probably heard me talk about this, is it's not the news that's so important, but it's the reaction to news, specifically bad news, that I like to pay attention to. You can tell a lot more about a stock's likely direction by the reaction to the news. So savvy investors understand that price movement is the ultimate arbiter of decisions because, after all, price is the only thing that pays. So when Tesla came out with the news, shares sliced below the 50-day moving average and then ripped higher. So such price action indicates a shakeout where weak hands get stopped out of their positions, clearing the way for the next move higher. And now Tesla is triggering a bullish swing trade signal by clearing last week's high. So on your screen, you're seeing a weekly chart, but you can see the stock shook out quickly and then immediately found buyers. So it actually finished last week positive despite that negative news headline. So again, the price action versus news is telling us that on any news, buyers are willing to swoop up shares of Tesla. Now, is the Cybertruck hype real? Remember, the Cybertruck is this kind of alien-looking truck that Elon Musk is coming out with, and they've actually just started deliveries. And many Tesla bears suggest that the hype around Tesla's Cybertruck is unfounded. However, recent Google Trends data suggests that the opposite is true. As Tesla investor and enthusiast Sawyer Merritt points out, Tesla has surpassed Ford to become the most searched auto brand in the US. Tesla's gone from not making the rankings at all in 2022 to second place in 2023 out of all car brands, and now they're the number one search car brand as far as US automakers go, and Tesla's the yellow line here. They're only behind Toyota globally. So that is definitely a positive trend that suggests the Cybertruck hype may be real. And you can't talk about Tesla without talking about China because it's one of its bigger markets. And despite a floundering Chinese economy, I mean, China's economy has been doing poorly for years now. Despite that floundering Chinese economy, recent registration numbers suggest that Tesla is on pace to break its quarterly record for deliveries in China. So as an investor, you want to ask yourself, now what if China's economy just stabilizes or even turns up a little bit? I think that's going to mean sales are going to spike for Tesla. So that's another bullish side of things on the Tesla front here. Now let's talk the overall EV market. So EVs to surpass 2/3 of global car sales by 2030. Ahead of the Climate Week New York City conference, 3 separate pieces of research from RMI Systems, ChangeLab, and EEIST project highlight the speed and scale of acceleration in the transition to EVs. Global EVs are on track to meet or outpace even the most ambitious net zero timelines and could account for more than 2/3 of market share by 2030, following exponential growth trends. Combustion car sales peaked in 2017, according to this study, and by the middle of the decade, more will be scrapped than sold, meaning the overall fleet of combustion cars is about to peak and will be in free fall by 2030. So if this S-curve trajectory is to be true, Tesla stock is going to be higher. I mean, Tesla owns the EV market, so if this S-curve grows the way these people expect it to, the way I expect it to, Tesla should be at all-time highs sooner rather than later. And then Tesla has some of the juiciest profit margins in the industry. So if you listen to Ron Barron, by the way, for those of you who don't know, Ron Barron is a legendary American investor and founder of Barron Capital Group, a prominent investment management firm. Among Barron's most recent investment triumphs is his oversized Tesla investment. So perhaps no one else outside of Elon Musk has a better grip on the leading EV maker than Barron. He invested more than $500 million in Tesla between 2014 and 2016, and he's held it ever since. So he's got more than $5 billion in profits, and it's catapulted his firm to being the only mutual fund to beat the NASDAQ composite over the past 5, 10, and 15 years. So that's saying something about Ron Barron's credibility, in my opinion. And in a recent CNBC interview, Barron said Ford loses $36,000 per EV produced, while Tesla makes $8,000 to $9,000 per car. Meanwhile, Tesla plants make about $15 billion per year on a $7 billion investment. So if you look at an ordinary industrial company, they normally make about 15 to 20% on capital at the most, while Elon Musk is making 100%. So no one is producing the kind of margins and returns that Elon Musk and Tesla are, at least no one that I've seen in this industry. And then let's talk about the competition. We did talk about them a little bit, but Ford cuts planned 2024 production of electric F-150 Lightning in half. So thus far, all of the fully EV-focused automakers like Rivian have yet to achieve a quarterly profit. And as Elon Musk points out, it's one thing to create a prototype, and it's a whole nother animal to manufacture at scale. And obviously, that's what originally catapulted Ford and the Model T into prominence, is they were able to manufacture the best back in the day. Now it looks like Tesla is. So the only other profitable EV maker in the U.S., which is Ford, they're cutting their F-150 in half. And that was supposed to be the biggest threat to the Cybertruck. Now it doesn't look like so much of a threat. So again, another bullish point for Tesla. And finally, there is a plethora of fresh catalysts. We have the semi-truck, full self-driving, Cybertruck, and the Gigafactories, to name a few. And one of the bigger ones and kind of fights against an integral bear case, which is this argument that Tesla is only focused on the rich. Reuters pointed out that the days of only focusing on luxury clients are coming to an end. Elon Musk plans to build a mass market vehicle in its new Gigafactory that will retail for about $25,000 US. So it's going to be even cheaper or less expensive than the Model 3, and that should spur on even more growth among these other catalysts that I point out. So those are my main bull arguments for Tesla. And thanks so much, everyone, for watching. But stay tuned. My colleague, Brian Hayes, he's going to walk you through a dividend play. So on to Brian.
Thanks, Andrew. Brian Hayes here with our other top stock pick. I have another exciting stock for you today, so let's jump right in. My top stock pick is one of the largest stock exchange operators by volume in the United States. The company boasts a compelling inorganic growth story given its prudent string of acquisitions. The company I'm referring to is CBOE Global Markets, ticker symbol CBOE. The stock hit an all-time high recently and is displaying relative strength this year. CBOE Global Markets operates primarily as a global options exchange. The company offers cutting-edge trading and investment solutions. In addition, the company offers CBOE Clear Digital, a regulated clearinghouse. CBOE has strategic relationships with several well-known industry players, such as S&P Dow Jones Indices, IHS Markit Limited, and MSCI Incorporated. The company was founded back in 1973 and is based in Chicago, Illinois. So that's a bit about CBOE's background and services. Let's shift gears a bit and look at this company's industry group. Digging a bit deeper, CBOE Global Markets is part of the Zacks Securities and Exchanges industry group, which is currently ranked in the top 8% out of approximately 250 industries. Because it is ranked in the top half of all Zacks ranked industries, we expect this group to outperform over the next 3 to 6 months. Quantitative research studies suggest about half of a stock's future price appreciation is due to its industry grouping. In fact, the top 50% of Zacks ranked industries outperforms the bottom 50% by a factor of more than 2 to 1. So by targeting stocks contained within leading industry groups, we can dramatically improve our odds of success. And moving to our snapshot page here, we can see that CBOE is a Zacks ranked number 1 strong buy stock. The exchange operator has established a healthy track record of beating earnings estimates. CBOE has delivered a 4.07% average earnings surprise over the last 4 quarters. So they've been consistently beating earnings estimates, and the stock price has reflected this. CBOE stock is widely outperforming the S&P 500 this year with a greater than 40% return. And we can see here that analysts covering CBOE are in agreement and have been raising earnings estimates across the board. Estimates for the next fiscal year have been increased by 4.7% in the past 60 days. The 2024 Zacks consensus EPS estimate now stands at $8.02 a share, reflecting potential growth of roughly 5.6% relative to this year. Revenues for the year are projected to climb 5.3% to $2.01 billion. It's exactly the type of trend we want to look for when narrowing down our list of potential stocks. So CBOE Global Markets, ticker symbol CBOE, is my top pick of the week. As trading volumes continue to increase, the future looks bright for this highly ranked leading stock. I see more upside ahead for this company as they've been able to adapt and grow through strategic acquisitions. From Andrew and I, and all of us here at Zacks, thank you for watching and happy holidays. Make sure to tune in next week for more of our top stock picks.